Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Perdoceo Education Corporation Annual Report. Perdoceo Education Corporation offers a wide range of post-secondary education programs through various segments. The company's primary business includes providing online, campus-based, and blended learning programs to students across the United States. The three main segments operated by Perdoceo Education Corporation are Colorado Technical University, CTU, the American Intercontinental University System, AIUS, and University of St. Augustine for Health Sciences, USAHS. These segments offer various academic programs in fields such as business, management, nursing, healthcare management, computer science, engineering, information systems and technology, project management, cybersecurity, and criminal justice. In addition to these degree-granting programs, Perdoceo Education Corporation also provides non-degree seeking and professional development programs. The company's USAHS segment offers graduate health sciences degrees in physical therapy, occupational therapy, speech-language therapy, and nursing, as well as continuing education programs. Furthermore, the company operates IntelliPath, a learning platform, which includes a mobile application and two-way messaging platform. This technology enables students to access educational resources and communicate with instructors remotely. Overall, Perdoceo Education Corporation's diverse range of programs and services cater to various needs of students seeking post-secondary education in the United States. Perdoceo Education Corporation's stock price has experienced a significant surge of over 28.15% in the past year due to several key factors. One major contributor was the company's robust quarterly earnings throughout 2025, consistently surpassing analyst expectations with strong revenue growth and improved financial performance. The acquisition of the University of St. Augustine for Health Sciences, USAHS, played a significant role in driving revenue growth, with Perdoceo reporting a 26.6% year-over-year increase in revenue in its first quarter earnings report. The company also saw growth in enrollments at Colorado Technical University, CTU, further boosting revenue. Perdoceo's strong financial performance was not limited to quarterly earnings reports. The company reported a 24.2% increase in full-year 2025 revenue and a 25.8% rise in adjusted operating income, with total student enrollments increasing by 7.3%. This positive outlook was further reinforced by the company's guidance for the first quarter and full year 2026, which included expected adjusted operating income between $250 million and $263 million. In addition to its strong financial performance, Perdoceo has also made strategic capital allocation decisions that have contributed to investor confidence. The company increased its quarterly dividend to $0.15 per share, and announced a new $100 million share repurchase program, demonstrating its commitment to returning value to shareholders. Overall, the combination of Perdoceo's strong financial performance, strategic acquisitions, and optimistic guidance has fueled investor confidence and led to a substantial increase in the company's stock price over the past year. Perdoceo Education Corporation maintains a market capitalization of $2 billion, broadly in line with the industry peer group. Perdoceo Education Corporation trades at a higher price-to-earnings ratio of 14 times and a higher price-to-book ratio of 2.11 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The balance sheet appears very conservative, with liabilities representing only 22% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth or decline for the company can be identified through an analysis of various key points. On the growth side, the acquisition of University of St. Augustine for Health Sciences, USAHS, in 2024 significantly contributed to increased revenue. Additionally, the adoption of IntelliPath learning platform and data analytics technology by CTU and AIUS led to a rise in revenue. Furthermore, Title IV program funding accounted for a substantial portion of tuition payments, contributing to revenue growth. Increased student enrollments also played a crucial role, with CTU's enrollment rising by 4% and USAHS enrollment experiencing a significant jump from 10,041 in 2024 to 157,576 in 2025. On the other hand, several factors contributed to revenue decline. A decrease in other revenue was observed, with CTU's other revenue decreasing by 45.6% from 2023 to 2024. Moreover, AIUS enrollment declined by 1% from 227,072 in 2024 to 226,220 in 2025. The increase in amortization expense for intangible assets and the expected decrease in future amortization associated with amortizable intangible assets also suggest a potential decline in revenue growth. Overall, these key points highlight the importance of considering various factors when analyzing revenue growth or decline. By examining both the drivers of growth and decline, stakeholders can gain a comprehensive understanding of the company's performance and make informed decisions. Net income and profit margins experienced fluctuations between 2024 and 2025. Initially, net income increased by 12.5% from $174.3 million to $196 million in the first period. However, it decreased by 9.1% from $161,971 to $147,012 in a later period. Profit margins also underwent changes, with adjusted operating income margin increasing from 108.3% to 123.4%, but net income margin decreasing from 21.7% to 18.9%. These variations can be attributed to several factors, including regulatory changes, potential loss of Title IV eligibility, reduced student enrollments, and increased competition from traditional institutions and online education providers. The company's financial performance indicates a consistent generation of positive operating cash flow. According to various sections of the report, the company has been able to generate cash from its operations, with improvements in 2025 and expectations for continued growth in 2026. This is explicitly stated on multiple occasions, including pages 59, 60, and 61, where it is confirmed that the company is indeed generating positive operating cash flow. However, there is one instance of conflicting information on page 106, which reports negative operating cash flow for all 3 years, but this appears to be an error or discrepancy in the report, as it contradicts the other pages. Therefore, based on the majority of evidence, it can be concluded that the company is generating positive operating cash flow. The company's debt level and interest expenses have undergone significant changes over the past few years. Initially, there was a slight increase in total debt from $145,336 in 2024 to $137,498 in 2025. However, this trend was reversed, as the total debt decreased significantly from $503,062 to $531,413. In terms of interest expenses, there has been a notable decrease from 2023 to 2024 and continued low levels in 2025 compared to previous years. However, an increase is observed in interest paid on finance leases, rising from $81 in 2024 to $6,196 in 2025. This trend is also reflected in the interest expense related to finance leases, which increased from $81 in 2024 to $813 in 2025. The company's use of sale-leaseback financing and construction financing has also undergone changes. Sale-leaseback financing saw a significant increase of $56,992, while construction financing decreased by $56,500. These fluctuations indicate that the company is actively managing its debt levels through various financing options. The performance of various segments and regions in the extracted summaries reveals a mixed picture. On the positive side, two institutions stood out as high performers. Colorado Technical University, CTU, and the American Intercontinental University System, AIUS, demonstrated strong results, showcasing their ability to meet or exceed expectations. In contrast, one segment struggled to keep pace with its peers. The University of St. Augustine for Health Sciences, USAHS, underperformed in the same period, indicating areas that require improvement. These findings highlight the importance of identifying and addressing weaknesses within individual segments to ensure overall success. Management's outlook for the company is optimistic, with a focus on improving financial performance and cash flow management. They expect revenue from students to be consistent across different universities and programs, and anticipate being able to satisfy liquidity requirements through 2026. The company has a strong cash position due to increased operating income, which will enable it to continue generating cash and investing in organic projects. Management's strategy is centered around maintaining a balanced capital allocation approach, focusing on maintaining a strong balance sheet and adequate liquidity, while also evaluating strategies to enhance stockholder value. They plan to repurchase up to $100 million of outstanding common stock through a new stock repurchase program approved by the board of directors. Additionally, they will continue to monitor financial market risks, primarily changes in interest rates, and perform regular impairment testing of intangible assets. Overall, management's outlook and strategy are designed to drive long-term growth and profitability while minimizing risk. By maintaining a strong balance sheet, investing in organic projects, and evaluating strategies to enhance stockholder value, the company is well-positioned for success in 2026 and beyond. The company has made several significant acquisitions and divestitures over the past few years. In terms of acquisitions, the company has purchased Trident and USAHS. A change in ownership occurred for USAHS, and two business acquisitions were made in 2024 and 2025, totaling $24,535. These acquisitions are expected to bring in new revenue streams and expand the company's services. On the other hand, the company has also made some divestitures, including terminating compensation payments to affected employees and changing contractual arrangements with third parties. A failed sale-leaseback transaction was also reported, but no specific details were provided. The company has demonstrated its commitment to returning value to shareholders through two key initiatives. Firstly, it has a history of paying dividends, with a notable example being the payment of $36.9 million in dividends for 2025, as mentioned on page 61. This indicates that the company prioritizes rewarding its investors and recognizes their importance. In addition to dividend payments, the company has also engaged in share buybacks. Specifically, it repurchased 4.1 million shares for $120.8 million in 2025, as stated on page 61. This strategic move allows the company to reduce its outstanding share count, potentially increasing earnings per share and enhancing shareholder value. That concludes the financial summary for Perdoceo Education Corporation. Feel free to comment below, and I will be happy to answer them when possible.